Hey guys, welcome back to Smart Wallet and Me, where financial wisdom really matters. We are living in unprecedented times. If you think that the 2008 collapse was devastating, wait until you hear what's happening in 2020. In this video, I will address what's really going on in the economy and what you can do to protect yourself. So let's get into it. We are at a very critical point where many commercial real estate companies will soon go bankrupt. Yelp data suggests that 60% of business closures due to the coronavirus pandemic is now permanent. The Fed is creating a liquidity trap where interest rates are low at almost 0% until 2023. In the last 65 years, interest rates hit around 0% only 2 times, in 2009 and 2020. But why, do you ask, has the Fed done this? Why have they pushed interest rates as low as they possibly can push them before it gets into the negative territory? They did this because they have to stimulate the economy. They need people to be able to borrow as much as possible so they can buy, spend, invest, and keep the financial system ticking. Or else a collapse might have already happened. The Fed is trying to artificially stimulate the economy by inflating asset prices like real estate and stocks. The goal of keeping interest rates low is to stimulate the economy by discouraging people from saving their money and instead causing people to invest it in assets and buying items because some prices are deflated, because that's the way they're going to get the economy to get rolling again. However, there is a problem with this theory that the Fed is playing with called a liquidity trap. What is a liquidity trap? The liquidity trap is the inability of a central bank to stimulate economic growth through interest rate cuts. Remember, the goal is to stimulate spending by making borrowing cheaper and saving less attractive. The trap opens up when the public's demand for goods and services is so weak that even an interest rate of 0 fails to juice activity. During the last 2008 financial crisis, the Fed attempted to stimulate the economy by implementing monetary easing policies such as QE1, QE2, and QE3. All that did is create a bigger debt bubble. I don't know if you guys remember what happened around 2007 and 2008 when it came to the housing market crash. Put simply, banks became very loose with their lending policies, allowing people to borrow more than they could afford. This created house prices to shoot up because of the high demand, creating a bubble which eventually popped. The interesting thing is that we are seeing a scary repeat happening today. There is a comparable mix of ingredients right now in the housing market and commercial real estate market as there was almost 12 years ago. With interest rates so low, people are buying real estate again and putting their money in the stock market, creating a massive bubble with overvalued stocks and home prices. The difference this time is that this time people are losing their jobs and they are not in a financial stable situation. In fact, the coronavirus pandemic has created problems for many malls going belly up. A research analyst report from UBS predicts that 100,000 brick and mortar US retail stores will close by 2025, in a trend that started before the pandemic and has accelerated amid coronavirus-related shutdowns. On a micro level, what this literally means is that more jobs would be lost, creating a deeper financial crisis for the average person, thereby creating a macro level crisis with an economic financial collapse created by the liquidity trap where fewer and fewer people would want to spend their money. Already we could see that the US savings rate hit a record 33% as the coronavirus is causing more Americans to stock up on cash. As many retail stores close and go bankrupt, more and more malls can't receive their lease payments and will be forced to shut down or convert the mall into a massive warehouse for Amazon and other e-commerce stores. As a result, when these businesses and malls shut down, they will create a majority of the job losses in our country. According to Statista.com, almost 8 million jobs would be lost in the retail industry, and if you include food and drink, there could be close to 20 million jobs at risk of being lost. As more and more people begin to lose their jobs, they would be hard-pressed to pay their rents and home mortgages, creating another pop in the real estate and commercial industries. Roughly 32% of American households haven't made their complete housing payment in July. The Federal Housing Finance Administration has extended the moratorium for both evictions and foreclosures until the end of the year. The crisis only seems to get worse. On the other hand, e-commerce has surged, even as stores reopen, as people are afraid of catching the virus in crowds and public spaces. There is already word that a second lockdown in Europe is highly probable given the current coronavirus spike. We could have a second lockdown in the US if this trend continues. And if we do have a second lockdown, you can bet that there would be even more bankruptcies and more job losses in the future. This situation has allowed only a few big names like Amazon, Target, and Walmart in the playing field to succeed and rise further on top. With Black Friday just around the corner, many businesses rely on that day for most of their sales throughout the year. Since foot traffic will be down and many people out of work, what do you guys think will happen? I'm interested to find out your thoughts by leaving your comments down below. The coronavirus pandemic has pushed US companies to go bankrupt at a rate that could make 2020 the worst year for bankruptcy since 2010 during the fallout of the Great Recession, according to a new report from S&P Global. More companies have gone bankrupt through August 13 of this year compared to the same period in previous years going back to 2010. 424 companies have gone bankrupt in 2020 through August 9, compared to 546 over the same period in 2010. Experts think 2020 could match or exceed 2010 for business bankruptcies. 2010 saw 819 companies file for bankruptcy, according to S&P Global, with millions of jobs being lost and hundreds of companies going bankrupt. If more and more companies are going bankrupt and more people are losing their jobs, there would be less people willing to spend their money, which the Fed is heavily banking on to stimulate this economy. The Fed has to be very careful to deal with the liquidity trap. They are inflating another bubble in real estate and stocks by keeping interest rates low and spurring people to get into the market and buying other assets. It is yet to be seen if history would repeat itself and follow another major crash not too long in the distant future. If you found this information helpful, please click that like button right now and consider subscribing to my channel for more informative videos like this. Thanks for watching, and I'll see you in the next video.